Netwealth Investments Limited is licensed to provide general advice. Our podcasts are not tailored to any one financial situation and may contain views of our presenters which may not align with Netwealth. The guests, organisation and Netwealth have an arrangement for their financial products to be available for investment through Netwealth platforms, and Netwealth may receive fees from the guest. More information about Netwealth can be found at our website, including our financial services guide and disclosure documents. Please seek professional advice before acting.
Welcome to the Netwealth Portfolio Construction Podcast, brought to you by the Netwealth Investment Research Team. Join us as we speak with key wealth management professionals to uncover opportunities and challenges on a diverse range of topics.
The breadth of opportunities means that there's niches in the market where you can find growth segments in just about any condition of the economy.
With your host, Paul O'Connor.
Welcome to the Netwealth Portfolio Construction Podcast. My name's Paul O'Connor and I'm Head of Strategy and Development for the investment options offered on our investment menus. For today's podcast, we have two guests joining us, being Richard Ivers and Mike Younger from Prime Value Asset Management, or Prime Value, and we'll discuss Australian small cap stocks and portfolio management. Richard and Mike are the co-portfolio managers of the Prime Value Emerging Opportunities Fund, which employs a relatively concentrated portfolio of between 25 and 50 ex-ASX 100 small cap stocks with a quality bias overlay. The fund can also invest up to 20% in cash and hold up to 20% of the portfolio in Australian unlisted equities and New Zealand stocks. We'll discuss this differentiated strategy in detail during the podcast today. Mike and Richard, thanks for joining us today.
Hi, Paul. Thanks for having us.
Yeah, thank you, Paul.
Prime Value is a boutique Australian investment manager established in 1998. It currently manages around $1.2 billion of assets in Australian equities, cash-like instruments and alternatives, namely agricultural assets and retirement living, as at June 2023. Prime Value is owned by the Law Family Office and operates alongside sister company Shakespeare Property Group, with total group FUM in excess of $3 billion. Richard Ivers has 21 years' experience covering Australian equities in both portfolio management and research analyst roles. Most recently, Richard worked at Contango for 2 years and was the portfolio manager of the Small Companies Fund, which generated top quartile returns over that period. He's also worked as a portfolio manager at River Capital and as a senior research analyst at Ord Minnett, where he was highly ranked. Richard has also gained an understanding of business strategy and finance through his roles working for a number of companies in the IT and finance sectors in Europe. Mike Younger has 25 years of Australian equity market experience. Prior to Prime Value, his most recent role was as portfolio manager of the Rest Australian Equities small cap portfolio. And before this, he served as head of small cap equity research at both Goldman's and Citi. So we have two eminently qualified and experienced small cap investors to take us through the small cap market and how their portfolio is managed. The Netwealth Super and IDPS investment menus include two Prime Value funds, being the Opportunities Fund that invests in listed Australian equities across all market cap segments, and the Emerging Opportunities Fund that Richard and Mike manage. Many Australian investors have allocated a portion of their Australian equities allocation to active Australian equity small cap strategies, basically in search of higher returns over large cap Australian equities, and also due to the larger number of active small cap managers that outperform the market. The search for higher returns, though, needs to be balanced with the higher volatility of the sector. But over the long term, the return has compensated investors for the higher risk. In recent years, however, the S&P ASX Small Companies Index has underperformed the broader large cap market, so many investors are now asking themselves, is now an opportune time to consider an allocation to Australian small caps? The investment styles of small cap managers in the universe includes value, growth and style neutral strategies, and whilst investors might be attracted to growth style managers on the assumption the sector is basically full of many growth stock opportunities, these managers do typically produce higher vol compared to value and style neutral strategies. So I'll be interested in Richard and Mike's views on investment style and the differing risk and return outcomes they may generate. Maybe to start with, gents, can you provide a few comments to the listeners on what attracted you to both managing small cap portfolios?
I started basically looking at small caps from the very beginning of my career. So it's kind of what I learned from the beginning. I did do some large cap work. This is on the broking side, on the sell side. In fact, News Corp was was actually the first company I ever looked at, and we actually hold it in the portfolio now, some 30 odd years later. But I think opportunities in the small cap space is really exciting. There's always some part of the market or economy that's doing well in almost any condition. And so there's these niche opportunities and uncovered opportunities as well. So you're sort of finding those diamonds out there that are uncovered is really exciting.
Yeah, and I'd say similar to Richard, it's really the opportunity set that you have at your disposal. So the more you can increase the size of your investment universe, the more opportunity you have to find these great companies to invest in. And so in a small cap market, while there is 200 stocks in the index, there is 2,000 that are listed on the ASX that sit outside of the top 100. And so there's plenty of areas to look at to find great opportunities.
Yeah, well, I guess to a degree, my take is that it would be interesting in the fact that you're not spending 30 years covering the top 4 banks in Australia or the 2 biggest miners in Australia. So I guess the breadth of industry and companies and business models would make it quite attractive, I would have thought, from a career perspective. Maybe just moving into the questions for today's podcast, can we start by discussing the S&P ASX Small Ordinaries Total Return Index? There is a higher prevalence of active managers such as yourselves who've outperformed the index, which certainly builds a strong case that investors should consider using an active manager in this sector. But what do you think are the core reasons for this alpha opportunity?
The small cap part of the market is a more inefficient part of the market. As Mike highlighted, there's 2,000 companies out there, and the coverage on each of those companies is far, far fewer and less than there is in the large caps, which is only 100. And there's a lot of eyes and analysts looking at that smaller opportunity set. So by definition, there's more opportunities to find mispriced opportunities in the small cap space. Being professional investors, us and our peers, that focus 100% of our time on looking for those opportunities means that there's just more opportunities to find growth and mispriced companies out there. There's also some structural factors that are happening as well, I think. So the broker coverage of small caps in the market has been declining, and there tends to be a fewer experienced analysts out there covering it as well. So that as well helps the inefficiency of the market and provides opportunities for us on the buy side. The only other thing I'd say is that the breadth of opportunities means that there's niches in the market where you can find growth segments in just about any condition of the economy. There's just far better opportunities to generate positive returns through just about any condition. I mean, sometimes you get the markets that misprice opportunities and misprice stocks such that they get hit down in the small cap space, but that's temporary. If you've got the fundamentals that are growing, inevitably the value will come through, and so you'll get those returns over time. And what you've touched on is really important too, because recent years, the small cap index perhaps hasn't performed as well as the large caps, but the opportunity for alpha in small caps is one of the main reasons why you invest. So you can't just look at it on the index level. You have to look at it on the returns that funds in this space generate.
Why do you think the sell-side coverage of the small cap sector of the market's been reducing? I would have thought it would have been the opposite over the last decade, but I have heard a few other people make that comment there, Richard.
Yeah, I think commissions and turnover has been under pressure. The budgets of the brokers has been lower by definition. And so there tend to be fewer analysts and less experienced analysts covering the sector just because those budgets are tighter on the broking side.
Is the index more diversified by industry compared to the large cap sector? And I'm guessing it is, given the dominance in the large cap sector of financials, energy, mining. So what investment style do you think suited to managing an active small cap strategy?
Yeah, it certainly is more diversified. So financials, as you touch on there, Paul, is around a third of the ASX 100 index, whereas in the small cap index, it's just over 10%. That's the single biggest difference. The other one where there's a large discrepancy is consumer discretionary, which is about just over 15% of the small cap index versus just over 5% of the large cap. And consumer discretionary, it involves a lot of different subsectors within it. So it's not just retail, but it's things like education, travel, auto parts, and I think there's a couple of other subsectors in there as well. So it is a lot more diversified market, and it's also diversified by stock. So if you think about the large cap index, CommBank might be, I don't know the exact number, but 9 or 10% of the market. Whereas in small caps, the largest stock gets to about 2% of the index before it graduates, or as we like to think of, gets demoted to the ASX 100 index. And so you do have a lot more diversity in the small cap index by both stock and sector. As to styles, we're really focused on trying to pick companies whose earnings are quite predictable. And so we don't tend to throw the portfolio around a lot when you do get different types of market conditions. And the last half dozen years or so, you've had almost everything. You've had bull markets and bear markets and interest rates going up and down. You've had a global pandemic thrown in there for good measure. And so it's very difficult to pick these inflection points. And we tend to manage to what we regard as more of a growth as a reasonable price type of style, which is really just focused on, as Richard mentioned, the underlying fundamentals of each company and trying to invest in those that we believe we have a better chance of predicting what the profit outcomes are going to be on a 3 to 5 year view.
Sort of makes sense there, I guess, Mike, a GARP style. And to me, it's about not overpaying for a business, even if it is a quality business and growing, that you've got to have some type of valuation discipline in your process there. So it sort of makes sense to me that managing your portfolio to a GARP style. Do you invest in companies that are not yet profitable, but you might believe are really well run with good management and are receiving a strong, I guess, growing market share for their goods or services?
We can, but we rarely do. So we prefer business models that are tested and have proven economics and that can generate a profit. I mean, it's easy to grow market share if you sell a product at an artificially low price. It's harder to grow market share and make a reasonable return on capital for shareholders. So we tend to focus more on those ones that are generating a profit and have proven those economics. We would be more willing to invest in a business that is losing money would be for some unusual downturn. And COVID was a great example of that, whereby we invested in Auckland Airport's tier one infrastructure asset that was losing money just because airplanes stopped flying. That to us is, a great opportunity, and we did invest through that. We'd possibly be more willing to invest in maybe loss-making division, a company that has loss-making divisions or the like. It comes into play because you can't throw the baby out with the bathwater, I guess, and that you can have businesses whereby they have, a core business that's profitable and growing and has a proven economics, but they might have a division that's losing money, and that's an optionality to us. And we wouldn't capitalize that and put those losses on, say, 20 times earnings. We would obviously put it as a neutral or potentially positive value, depending on our view of that part of the business. There's actually an example of that recently with EQT, or Equity Trustees, which is one of our holdings. They had some operations in UK and Ireland and were losing money. And we basically valued that at zero rather than capitalizing it. Out of the blue, they decided to cease operations and exited there with pretty much minimal costs. And so all of a sudden, those losses were gone, and then the reported profits rebounded, not through anything changing in the core business, but just by exiting a loss-making business. So I guess we're more conscious of loss-making and more forgiving of loss-making in a business like that has a core business that's profitable, but is maybe have a growth option that's trying to drive another part of the business, but is losing money.
Yeah, well, I guess that makes sense to me there, Richard. And history's full of companies that have had loss-making arms and parts of their business. And once they get that cleaned up, the re-rating and repricing of the stock can be just phenomenal. Probably one that really bears home to mind was Standard & Poor's, when they actually got rid of the old publishing arm, McGraw-Hill, and really unlocked the value of just being a pure financial services company there. And the returns have just been fantastic since they did that restructure. So it certainly makes sense, but you've really got to have an in-depth knowledge and understanding of the corporate business model, I guess, and the industry in which it operates to be able to capture that. So does the size of funds under management matter when it comes to generating alpha in small cap stocks? And I know some small cap stocks are managing in excess of $1 billion, others are sub 100 million. And thinking if your universe is the complete X100, you're getting down to some pretty small companies. So I'd imagine the more funds under management you would have, potentially, the more limited that universe is.
Yeah, absolutely. It does matter. And there's a very high correlation or inverse correlation, if you like, of alpha to fund size. So small caps would be an asset class where you've got one of the smallest sort of capacities. And so it becomes really important where if you are too big, you own very significant amounts of each company that you're investing in. The largest small cap managers in the country almost have to be substantial in the majority of businesses they invest in. That is above 5% of that company's issued capital. And so if you're making decisions to enter or exit, and that's going to involve 5 or 10% of a particular company's capital, that can take A, a very long time to execute, but B, it puts upwards and downwards pressure on the price. Generally, whenever you want to buy a stock, the share price inevitably rises as you're trying to buy it. And when you're trying to sell one, it inevitably falls as you're trying to sell it, which is quite frustrating. And so the bigger you are, the more exposure you have to that dynamic. So a lot of small cap managers will quote a number, say around roughly $1 billion as sort of the capacity of what they see as their strategy. We actually quote a number closer to $500 million because we feel like that gives us plenty of headroom to be able to grow without having any impost on performance.
I guess it's a fine line you're walking there, Mike. You've obviously got to have a profitable business arm there running small cap, so it can't be too small, the funds under management. And you also need enough income there to be able to be appropriately resourced, coupled with what you've just articulated there about having too big a funds under management then, and hence your trading, your impact on the market, the size of a corporate that you can actually hold in your portfolio all starts to dissipate there. And I guess that's, in my experience, why at times there can be such a large differential in returns of managers in the active small cap peer group. Small caps have historically outperformed mid and large cap indices, which is rational from modern portfolio theory given they display higher volatility. Why then has the index underperformed large and mid-cap stocks both in Australia and globally over the last 3 years or so?
It's been particularly evident, since interest rates started to rise, so since that January 2022 period, so the last 2.5 years. And over that period, the small cap index, so the small ords accumulation, is down 10%, and the large caps, or the ASX 100 accumulation, is up 18%. So, dramatic difference in performance. There's some compositional issues with that. The banks are a big chunk of the ASX 100, and they're up in the order of 40% if you include dividends over that time. And obviously there aren't not much in the way of banks, particularly the major banks in the small cap index. And I think likes of Rio is up 20% or so over that time as well. It is common to see when you go into a bear market or interest rate hiking cycle that small caps underperform. They tend to fall harder in the downturn, if you like, and then they rise faster in the upturn. They are higher beta plays. I would highlight that our fund is particularly strong at downside capture. So our downside capture is only 50 to 60%. So it provides a much smoother profile of returns over time. So we are differentiated to the index and our peers in that regard. But back to the major question as well, I mean, the reason for why the small cap index has underperformed so much over the last 2.5 years, there's a few different reasons. So they're perceived to be much more economically sensitive than the large caps. They have a higher proportion of debt that's variable. So small cap companies don't have the level of sophistication whereby they can hedge their debt profile as much as the large cap stocks. There's some of those issues that come into play. Again, it's an interesting time to be talking about this because just, last week we saw what can happen when the interest rate profile changes. In the US, we got that lower inflation number come out and the Russell 2000 rallied particularly hard, and the Magnificent Seven that's really driven returns, particularly over this really strong period in the US, was really underperformed the Russell 2000. So you got this reversal of what's been driving the market. In just 5 days, the US small caps outperformed the Magnificent Seven by 14%. So it can snap back really quickly. We haven't seen that here in Australia. We have a different interest rate profile here. So we have an interest rate decision coming in August where there's a potential for a hike rather than a cuts like what's happening in the US. But it does show you that you need to be ready and prepared, and you can't just wait for that to happen before investing in small caps, because it can happen really, really quickly, which makes, I think, the small cap sector really interesting right now because of that significant underperformance over the last 2.5 years versus large caps, and then the potential for cuts coming in 2025. So you can see, you got the underperformance, you can see the catalyst coming for that change.
Wealth is about more than just money. It's about opportunity and progress. Netwealth is supporting financial literacy and education in primary schools through Banker, a fun, interactive platform for children to learn about money. So far, we've sponsored and given over 120,000 children in Australia free access and want to reach even more. Discover a world of community and refer a teacher to Banker at banker.co/primary.
Small caps historically perform well at the start of each economic cycle, which I think you've alluded to there already, Richard, and tend to sell off quite hard towards the end of the cycle. So how much impact does momentum have on the index, and can you manage momentum or the beta play in your emerging opportunities fund?
Yeah, it certainly does have a very big impact on the index, as Richard's alluded to, and in particular the last couple of weeks in the US with small cap versus the Magnificent Seven. You've seen a very big move relative. But in terms of the way that we manage the portfolio, it doesn't have as much an impact. As I mentioned earlier, we try to be a fund for all seasons, if you like. And so the bulk of the portfolio is made up of companies where we view the earnings as being at relatively low risk compared to the investment universe we have at our disposal. We do play around at the edges, if you like, where if we think that there's an economic recovery coming, we might have a couple of cyclical stocks that might come into the portfolio in relatively small weights. But they're always going to be the minority of the portfolio. Most of it's going to be those companies that we view as being a lot more resilient in terms of their earnings growth outlooks, because at the end of the day, we just can't pick the timing. We don't know exactly when markets are going to turn. Markets have a history of turning a good 6 to 9 months before the actual economic data does. Trying to pick those peaks and troughs has proven very, very difficult for managers over a very long period of time.
And I guess it probably gets back to my earlier question and the comments you were making around buying. It's sort of about trying to build an all-weather portfolio that may miss some of the real strong upside momentum, but over the course of the whole cycle will give you a lower volatility and a good consistent return above the index. So it certainly makes sense there, Mike. Further on your strategy, it's differentiated from most of the peers, given you can hold up to 20% of the portfolio in cash, but also in unlisted stocks and also New Zealand stocks. What sort of advantages and challenges does this bring?
Just to start with the unlisted side, we can hold up to 20% unlisted, but we never have. It's unlikely we will. I mean, it has to be a very good opportunity for it to happen.
Lack of IPO, perhaps?
Yeah, but I guess our caution about it is that you can often get stuck in these assets whereby they're promising to IPO in 12 months, which is typical, and often it doesn't happen. So you get stuck without an option to exit. So that's our caution. If we were to do it, it would probably have to be a relatively short-term unlisted profile, so it would be IPOing very quickly. The cash, we can hold up to 20. We've never been above. Previously, we could actually hold up to 100. We actually brought that down to 20%. And just a few months ago, and we hadn't never been above 20, and our average has been about 10% over time. And we don't really manage to cash, we manage it to the opportunity, so it's really cash as an outcome. Where's more interesting perhaps is the New Zealand side of things. And we do invest in New Zealand regularly, and we travel to New Zealand regularly. It's just under 10% of the portfolio is in New Zealand listed stocks at the moment. We find it a really fertile hunting ground. It tends to be a lot of really high quality companies over there. Even though it's a relatively small market, it has a really good breeding ground for new companies coming up. Traveling over there, we tend to find that we get a really good understanding of the businesses. And I think it's less well covered than the Australian market. There's just fewer fund managers over there, and there's fewer Australian fund managers that travel over and invest in New Zealand companies as well. So like we're talking about inefficiencies in the market, I would argue that the New Zealand market is more inefficient than even the small cap market here in Australia. It's also interesting too because, there is differences in the economic cycle. So right here, there's potential rate increase in August, well, certainly not cuts coming, whereas New Zealand, the Reserve Bank of New Zealand over there has pretty well flagged that interest rate cuts are coming. So you've got a potential economic upturn coming from very low levels. It's tough over there now, but there's potential upturn coming. Whereas Australia, that upturn is probably a bit further out. So it gives us the opportunity to diversify the exposure to the economic cycle by investing in New Zealand as well.
Yeah, well, I guess their central bank has been a little bit ahead of the Australian central bank in the cash rate moves. So not surprising there, your comments there, Richard. You think the cash rate will start to taper off soon in New Zealand. But I guess it also seems rational that if you're looking at Australian small caps, understanding the Australian economy, the more successful New Zealand companies, I would assume, have a growing market presence in Australia. You'd be bumping across them anyway in your research.
Most Australian companies have operations in New Zealand, so we're familiar with it. We can talk to peers and competitors very easily. So, and it's very intuitive for us. A common, similar economic model, regulatory style. They're very welcoming of Aussies, even though we compete a lot in sport. So, it's a good place to invest, funnily enough. But at our core, we're Australian fund managers, and that will always be the vast majority of our holdings.
We've touched on earlier the Magnificent Seven, those 7 US megacap stocks that have been responsible for a large portion of US equity market returns in recent years, obviously have a large IT bias and obviously the flavour of the month being AI. So are there any opportunities to invest in any small cap IT stocks on the ASX or businesses with great opportunities to grow their market share in the AI space?
There are, but I caution that there's not many and even fewer that are profitable. And so we've tended to find that, Australia as a whole has a very small IT sector. And so I don't know the constituency of the S&P 500, but I think IT is, well north of sort of 15%, maybe even 20, 25% of that market cap. Whereas in Australia, it's, for the small cap market, it's 6 or 7%. And I think for the ASX 200 overall, it's even less than that. So it's pretty small. And the ones that have had success in small caps in recent times have actually moved through the index very quickly and moved into the top 100. So companies like WiseTech and Altium, for example. But these are traditional software type companies. It's not the exciting AI chips and what have you that the Magnificent Seven are benefiting from. And so there are some opportunities, but there's very few. That's potentially one of the reasons why they all also trade at very, very high valuations, often on revenue multiples, because the earnings isn't there, or if it is there, it's very nascent. The opportunities within that space are few and far between as we see it.
So what kinds of stocks and sectors do you believe can deliver consistent returns, and what does an attractive small cap stock look like to you guys?
When we look for stocks, we love stocks or businesses that have duration of revenues. By that I mean you can actually have visibility of these revenue streams out many, many years. The largest holding in the portfolio at the moment is a company called Equity Trustees, EQT. Their business has revenue streams that typically can last decades. In some instances, they're in theory infinite. They grow over time, which is, as you can imagine, highly, highly valuable. That company itself was founded in 1888. It was an auspicious year, but it was also shows you, a business that's been around that long, it has duration of earnings and sustainability as a business. And they're the sort of businesses we like. I think in small caps, there's often a tendency to get excited by what is new and exciting or happening at the particular moment. So it might be buy now, pay later, or there was medicinal marijuana, otherwise known as pot stocks, a few years ago as well. And these things tend to come and go a bit, and they typically, the valuations go astronomical. Everyone gets excited by it because I think it's a quick, easy win. We tend to avoid those types of spaces and invest in businesses that are growing and are high quality, but are potentially a bit less exciting, but can actually consistently grow over time. To be a top-performing small-cap fund manager, you don't have to shoot the lights out every year. It's really about consistency. That's how we think about it. We're not trying to be the number one every year, although we have been in the past, but we're trying to be a consistent generator of investment returns. And we think by doing that over time, the cream will rise to the top, and then on average, when you look at over a good time period, like 3 or 5 years, the investment returns will be really strong and will measure up really well against our peers and the index, which is evident in the numbers that we've been producing. So that's how we go about investing. It sounds boring, but it's not, and it can generate really, really good returns.
You may not be the life of the party at a dinner party talking about the latest and greatest stock or sector, but to a degree what you were saying there, Richard, is very rational, and that's what I would expect out of a quality active manager, not to get carried away with the old fear and greed that drives human beings, but to just stick to your knitting and stick to trying to buy good quality companies. Can volatility be managed in small caps, given the sector can at times be highly volatile? And I guess managing downside risk can have a material impact on the long-term performance of a portfolio.
Yeah, absolutely, Paul, it can be. And the answer is really portfolio construction. And so the weightings that you attach to the various companies that you hold in your portfolio is ultimately one way that you can manage volatility. It's one thing that we have looked at as an output across our portfolio, and it's a coincidence maybe, or maybe it's just the general nature of how Richard and I manage the fund. But we tend to have our larger holdings in companies that tend to exhibit less share price volatility. And so when we plot the chart, it's almost bottom left to top right in that manner. And it's really, that's the risk mitigation process that is coming out there. It's not something that we target. We don't design the overall portfolio standard deviation, but the way that we tend to think about companies and portfolio construction is such that we tend to have the larger holdings in the less volatile companies. And what it does is it means that you're not susceptible to one or two big winners or big losers in any particular performance period. It results in more consistent returns over time, because those companies that are your larger holdings that have less volatility, essentially they're moving around not as much as some of the other spicier stocks in your portfolio that do exhibit a lot more volatility, but they are lower weights, and so they have less impact on the overall portfolio return. So that's one way you can do it. And downside protection is certainly one way to outperform the small cap index. And so when we look at our historic performance, we've had over the last 6 years or so alpha against the index of something like 7% per annum. When we look at how that's been generated, when we break down on a monthly basis, in all the months where the market has been up, we broadly outperform half the time, whereas in all the months where the market has been down, we've outperformed in 80% of those months. And so that's really where we've been getting our alpha, is we don't draw down as much, but then we keep up with the market as it runs. That's essentially the way that this portfolio has been managed over time.
So maybe to wrap things up in the interest of time there, can you guys just give us a brief overview of what you think are the current opportunities in the marketplace and what's getting you really interested?
The largest holding in the fund, like I've mentioned a couple of times, is Equity Trustees, and it's had a bit of a good run this year, but we think there's a lot more upside in it. It's a business that, as highlighted earlier, has a really long duration revenue streams and a very high quality business, very sticky customers, strong cash flow, strong balance sheet, and is priced at a market multiple. So it's re-rated from below market multiple to market multiple now, and it's going through a very strong earnings period. It's typically relatively, dare I say, boring company. I mean, our high quality revenue is not very volatile, but it doesn't grow that strongly. Whereas at the moment, it's actually going through a growth spurt because of a couple of reasons. One, the key reason is that they made an acquisition of Australia Executive Trustees a couple of years ago from IOOF, as it was known, or Insignia. And that business was very complementary to EQT. And the synergies coming out of it that's driving earnings upside and really accelerating earnings growth over the next couple of years. And then they're also benefiting from Perpetual, their largest competitor in the space. There's only really two players, EQT and Perpetual, and Perpetual's under takeover offer has been distracted and is about to be taken over by KKR in terms of the Perpetual Trustees business. That means a competitor that is about to go into private equity ownership, and means that it's typically easier for equity trustees to win when they come up against that competitor. If you're an individual or a business looking to use a trustee organisation, I think you probably prefer one that's not private equity owned, and I think that's flowing through into market share gains for equity trustees.
Yeah, one I'd throw in is one that we recently actually added to the portfolio. Timing was a little fortuitous in that we first invested in Capital Health only a couple of months back, and the company since has received a takeover bid from integral diagnostics. But the attraction of capital in the first place was really down to, I guess, the industry itself in radiology, whereby you've got this wonderful dynamic of price and volume growth each and every year. And that's something we really like to see in companies that we invest in. Population growth and the ageing population is something that is driving up volumes and will for the long term. And similarly with pricing, it's one of the areas in healthcare that does get indexation, which helps these companies cover their costs. And that's obviously been a really big issue as we've come through the inflation years in recent times. And so for capital, you've also had more recently some budget changes which are going to prove positive for the industry in terms of being able to get Medicare funding on more MRIs that are in the field. And the acquisition by Integral is one which is going to make for obviously a larger scale player. Companies, whenever they announce merger transactions, they give a synergy estimate, and they always want to be very, very conservative. And so it's not uncommon that you ultimately see more synergies being extracted than what the companies initially are suggesting. And we think this will be no different in this time around. It's an industry in which, if you went back to the pre-COVID years, it was one which some infrastructure plus funds were starting to get involved in this sector, sort of viewing radiology as an infrastructure plus type of asset class. And so it is one that is very attractive, but the valuations are similarly relatively attractive now. And we've got this nice dynamic going forwards in terms of this long-term growth in volume and price, as well as a little bit of catch-up still to come from the COVID years, which has seen a lot more telehealth. And as telehealth has grown, that has resulted in less referrals for x-rays and the like than typically is the case. We're starting to see a little bit of an unwind of that. And over the next couple of years, I'd expect that you will get a bit more of that normalisation in volumes post the COVID years as well.
Yeah, well, I would imagine their market would also be a good diversifier in the portfolio, given anything related to healthcare is not linked to the economic cycle. So it would behave differently to a lot of the other stocks, I would imagine, in the index. Thank you, Mike. Thank you, Richard, very much for joining us on today's instalment of the Netwealth Portfolio Construction Podcast. Been a fair while since I've had a discussion with a small cap manager, so it's been really enjoyable and educative to myself there. So I certainly do appreciate the time and your input today there, gentlemen.
Thanks, Paul. Yeah, thanks very much for the opportunity.
Absolutely happy to assist there, Mike and Richard. A couple of the takeouts that I've had from today is certainly consistency of return of a small cap portfolio is really about buying a quality business that is profitable, but certainly not overpaying in terms of a valuation for that business. And also avoiding not following the latest trend or populist theme, but stick to your knittings and stick to your research there. Just a more general comment, and I guess I've had this view for many years now, but if you're considering an allocation to small caps, Aussie equities small caps are certainly a more inefficient, more volatile sector. Any sector of a portfolio that is more volatile, less efficient, I think is where the listener should really consider seriously the use of an active manager there because of that alpha opportunity, because of the inefficiencies that exist. And a good quality manager like Mike and Richard from Prime Value certainly, I think, have well articulated that opportunity. And also to the listeners, thank you very much for joining us again on another instalment of the Netwealth Portfolio Construction Podcast. And I look forward to joining you on the next instalment. Have a great day, everyone.
Thanks for listening to Netwealth's Portfolio Construction Podcast. Follow the show for future episodes. Leaving a review helps others find the podcast. And for more information and show transcripts, visit netwealth.com.au.